Hi, this is Mike Maloney, and earlier today, gold took a huge plunge. Silver took a dip, but it wasn't nearly as much as gold, which in itself says something very interesting. But I believe that these are the symptoms of something that I have been warning about over and over and over again for several years now. Basically, I believe that we cannot go into big inflation or hyperinflation until we've gone through a big deflationary dip first. We are nearing the end of a 100-year-old credit slash debt slash bond bubble. It's been developing for more than a century now, and it's coming to an end, and it's not going to be pretty. But when these things pop, this is a deflationary event. And we're also coming to the end of a global monetary system, and I've been talking about that for many, many years now. But this is also, the reason for gold's dip is also part of a manipulation and part deflationary implosion. And the reason I say that it's partly manipulation is because if you look at what's been happening lately, every time there's bad news that should cause gold to go up, gold falls. Greece starts to implode, gold falls. China, their stock market crashes and gold falls. And so how could this manipulation be happening? Well, Zero Hedge wrote a few articles a little while back. We'll post the link below this video. I encourage you to read it. But they were showing in the reports that JP Morgan had taken this huge commodities derivatives exposure that was just many, many, many times anything that has ever happened in history, and basically cornering a market when it comes to derivatives for commodities. And then Citigroup, at the same time, their precious metals derivatives exposure exploded by about the same type of percentage, just enormous, to where it really constitutes cornering of a market. The Hunt brothers, they say, cornered the market back in the late 70s, January of 1980, and this amounts to the same thing, except nobody's going to go to jail here. Nothing is even going to get investigated this time around. But this could be part of what is causing gold to fall every single time there's bad news. Now, I expected gold to fall anyway. It's just that when bad news comes out, and then at the same time that that comes out, gold plunges, or the news that came out yesterday that China had increased their gold holdings by 57%, and basically, they don't report anything for a very long time, and then in 1 month they report this 57% increase, which is pretty much impossible. But them reporting that they've accumulated so much gold should cause the price of gold to rise, not to fall. And what we get is this huge sell-off where somebody sold an incredible amount of gold futures all at once, which is this is not what you would do if you were trying to lock in profits. What you would do would be to sell these gradually over a period of days and not cause the price to fall so that you could make more from them. But they just sold them all at once, causing the price to just plummet. That's part of the manipulation. But the natural implosion, this deflationary implosion that I've been predicting for a long time, I'm showing this is a chart of light crude oil that was drawn by Clive Mond using stock charts, and he's made notations on here. I encourage you to read his article. It's posted below this video. He believes that a deflationary collapse is upon us right now and is just starting. And this is what I've been saying for years. This is crude oil, and back in 2000, 2010, when I was speaking at the Sochi banking conference, the banking conference in Sochi, Russia, I was predicting that oil would go down. Now, it took a little bit longer than I expected, but it is fulfilling the expectations that I made. I do think that you're going to see oil take a big plunge. Now, this is really bad news for Russia and Venezuela. In an article I did a year or so ago, I said the Venezuelan economy was falling apart. Their middle class has been wiped out, and the next steps in Venezuela would be hyperinflation and revolution. Well, their hyperinflation has begun. It's when a country that bases all of its revenues off of the sales of oil, like Venezuela does, when this price drops like this and revenues dry up, their only choice is to start printing like crazy, and that's what they've been doing. But another thing that I noticed on this chart, and I made these notations down at the bottom, if you take a look at the volume, you can see that up until late 2006, oil was an investment. There was normal investment and hedging going on by the producers and so on. And then in 2006, it became a speculation with all the high-frequency trading and everything. If you look at the amount of volume in here, this is an impossibility that this many people just suddenly jumped into the market in 2006. It's not possible. What this is all the big brokerage houses trading and the high-frequency trading done by computers. And so, but you can see that Clive Mond is expecting crude oil to plummet. He expects copper to plummet also. But here in the volume, and when something goes from being a legitimate investment and the volume being made up by producers that are hedging, locking in prices on future production, to a speculation where it's just a bunch of gambling, it introduces volatility. And that is one of the things that's going to really cause things to plummet and be a very wild ride in the future here. So he's expecting copper to plummet by half. He's expecting it to fall by half at least. Now, we've been through something similar to what we're going through before. If you were in this through the pullback of 2008, gold had gone over 1,000 for the first time ever back in early 2008, and then plummeted to under $700 in October of 2008 and bounced. But during that pullback, shortages developed in the physical market. This was all paper gold. It was futures contracts that were being sold off. It was futures and options being exercised on futures. Here's a chart of silver. Silver had broken 21, and then earlier in the year, and then in the same year, in 2008, plunged all the way below $9. Now, I'm a precious metals dealer, and during this period of time, what happened in October, November, and December is all of the suppliers, the main suppliers of gold and silver products, started running out. The U.S. Mint, the refineries, they started running out of gold and silver. And for a very long period of time, I could only get one gold product and one silver product at a time. We didn't have the big variety that we've got on our website. There was just one of each product available. For about 2 or 3 weeks, our only gold product was kilo bars. So you had to spend like $30,000 if you wanted to buy gold. There was a week where we had no gold, and there was 3 days where we had no gold or silver. We were basically out of business for 3 days, and we couldn't get any. There were no suppliers that had any. And what happened during this period of time is there was a huge divergence between the spot price and the price that you could obtain physical for. While silver was below $9 here, I got a call from a friend in Chicago, and he was a friend and a client. And his local coin shop was selling 100-ounce bars for more than $18 an ounce, so more than double the price. And what's interesting, silver has been falling recently, but the U.S. Mint announced that they were suspending silver sales. Now, we're still able to get a few Silver Eagles, but the prices that our suppliers are charging, their premium over spot has almost doubled. And as a result, the price of Silver Eagles hasn't really fallen. It's about the same as it was a few weeks ago. And that is probably what is going to happen if gold falls to where I think it's going to fall. It'll become very, very difficult to get unless you want to buy paper gold. Meanwhile, China continues to expand their purchases of gold. And this chart that I'm showing here is from a presentation that I gave last year. And what it's showing is that the deliveries from the Shanghai Gold Exchange, the bars in the background that are the light color, the light peach color, are world mine production excluding China. Now, China is the world's largest producer of gold, and so this is, but none of it is allowed to leave the country. So this is world production, the rest of the world's production, so it's total world production minus China, and then the deliveries that China takes off of the Shanghai Gold Exchange, not China, but all deliveries off of the Shanghai Gold Exchange in China. And what it shows is that China's appetite for gold exceeds the rest of the world's ability to produce gold. And this continues. Many people suspect that a lot of this was going toward their central bank, and lo and behold, they just announced that their central bank has increased their gold holdings by 57%. Many people believe that that is actually a lie, that it's a whole lot more than that that they have accumulated, and they're just making a statement where they think it's enough to give their own population confidence in their stock market, that China has this stability backed by gold at their central bank, and they're hoping for a stock market bounce. But many people believe that they've accumulated a whole lot more than this extra 57%. And so when you look at this trend of China accumulation, the pullback that we're going through will just be used for them to accumulate more. Now, this next chart, I want to show you that, in this century, the best performing asset has been precious metals. This is a chart of gold. This is since the NASDAQ peaked back in the year 2000 and then began to crash. So I lined this up with the market peaks back in 2000. And what you see here, the bottom line, the NASDAQ, after 15 years is back to break even. But this is not inflation adjusted. So the NASDAQ has lost a ton since the year 2000 when you inflation adjust it. The next line up is the S&P 500. The top line is the Dow Jones Industrial Average. And if you inflation adjust those, they're back to break even. But here, the best case scenario is that the Dow Jones is up about 70%, where gold is still up close to 300%. So it's been the best performing asset, and it's something that can't vanish. It's a physical, tangible asset. What we're going through right now, this huge pullback that we've been going through for the past few years, is something that I've been predicting and waiting for and I knew that the pullback of 2008 was not the capitulation pullback. There was a panic. People were trying to get into it, into gold and silver badly. And this time around, there has been some capitulation. We are seeing some people selling. And it's a shame. I think they're going to be selling it at lows. I do expect that gold will bottom in here sometime soon. it'll probably break 1,000 and go lower. I encourage you to read that Clive Mond article. But remember, that is the spot price. As shortages develop, the physical will diverge from spot. So if you're going to buy futures contracts and stuff, go ahead and wait for that bottom. But if you wait for that bottom to buy physical, you may end up paying a whole lot more, not less. But there will also be, when that bottoms, some tremendous values in mining stocks available. And so lastly, I want to go to a chart that I presented in a presentation last year. And I showed what I expected was gold would, I said that it could take off and continue rising from here, because many people were calling a bottom and saying that gold had already put in its bottom. And if it does, it'll be a slower continuous rise, more like the trajectory that we've had on gold since 2000. But what I expected was a pullback and then a much more violent rise that will take gold higher sooner. And the pullback appears to be what's happening. So I expected this deflationary plunge first, which would pull the price of gold down and cause it to rise significantly in the future. That's what I still expect. It's just that, will you be able to buy it at that price when it bottoms? That is something that I doubt that anybody will be able to actually buy physical at that bottom, because as a dealer, what we see is that the spreads, the premiums that all of the suppliers are charging is already going up, and we're nowhere near the bottom of this plunge that I've been expecting for a long time now. So that's it. Thanks a lot for listening, and we'll see you next time.
All the world is trying to expand its currencies supplies right now, thinking that they can stave off deflation, and they can't. And I'll show you why. As they print currency, you can't get the public to take on more debt if they don't want it.